Hello. Welcome to a Level 4 podcast focusing on financial performance. My name's Gareth. I'm Managing Director of First Intuition. First Intuition was very proud to win the UK Accountancy College of the Year in both 2010 and 2012. I was very excited to be the winner of the UK Lecturer of the Year for 2011, and we were recently nominated for Study Resource of the Year in 2013. Now, the purpose of these podcasts is to examine some areas in some of the AAT papers that students tend to find quite challenging. Over the last couple of years, the AAT have analyse the results that students have achieved in the various papers all the way through from level 2 up to level 4, and they've identified the tasks that students tend to find quite difficult, and particularly within the more challenging papers. And financial performance does tend to have some of the lower pass rates at level 4. And so what I'm going to do is examine a particular problem area that students often have and hopefully help you to be able to tackle it competently. Well, as I've already mentioned, financial performance is often considered to be one of the more challenging exams at level 4. And one of the areas that students often find quite hard to deal with is variances, and particularly looking at the fixed overhead variances. Now, you do need to be aware of how to calculate different variances for material costs, for labour costs, for instance. And variances do get touched on in the budgeting syllabus as well, so it's well worth making sure you're comfortable with how they work, but I'm going to focus in this podcast on the fixed overhead variances. Now, what you need to bear in mind is that we can take our overall fixed overhead variance and we can break the total fixed overhead variance down into two sub-variances: the fixed overhead expenditure variance and the fixed overhead volume variance. So initially you can break it down into a pair of variances, the expenditure variance and the volume variance. We can actually then break the fixed overhead volume variance down even further. That can be split down into two further variances: the fixed overhead efficiency variance and the fixed overhead capacity variance. So if we were to add up the fixed overhead efficiency variance and capacity variances, they should total the overall volume variance that we would have calculated. But it's important that you can calculate four different fixed overhead variances: fixed overhead expenditure, fixed overhead volume, fixed overhead efficiency, and fixed overhead capacity variances. And I'm going to take you through how to calculate each of those for a little illustrative example here. So, we've got some data laid out, budgeted fixed overheads, so that might be for the rent of the factory, for instance. Budgeted fixed overheads are £50,000. That's what we thought we were going to spend on our rent. Budgeted output is 10,000 units, which was expected to take 20,000 labour hours. Now, you can hopefully already see that we were evidently expecting each unit to take 2 hours of labour. That's what we sometimes refer to as a standard. That's a standard hours per unit of 2 hours. Now, the figures that I've highlighted in yellow there are all budgeted forecast figures. We're then told the actual output was 8,000 units, a bit lower than we were budgeting. Took 17,000 labour hours in total, and the actual fixed overheads were £52,500. And we're actually going to calculate all four fixed overhead variances that we might be asked for in the financial performance assessment. We're going to look at the expenditure, the volume, the efficiency, and the capacity variances. I'm going to take you through each of these calculations one by one. Well, let's start with the fixed overhead expenditure variance, which actually a lot of students find perhaps the easiest of the four to calculate. Now, there's different ways to calculate variances. I'll show you what I've always used as quite a common sense approach. And bear in mind that all of variances is a difference. There's fundamentally a difference between two numbers. Now, to work out the fixed overhead expenditure variance, what are we going to look at the difference between? Well, it's looking at expenditure, the amount we're spending on our fixed overheads, and it's literally the difference between our budgeted expenditure, so what did we think we were going to spend, and our actual expenditure, so what did we spend? So in our example, we saw that the budgeted fixed overhead was £50,000, that's what they thought they were going to spend. Actual fixed overhead was £52,500, so they spent a little bit more than they expected. Now if I fill these figures into my little pro forma here, so budgeted expenditure was £50,000, the actual expenditure was £52,500. The variance, or the difference, is in this case simply 2,500. Now, whenever you calculate a variance, it's very important you think about two things. Firstly, is the variance a good thing or a bad thing? Is it going to help improve profit or is it going to reduce profit? Now, in this case, we've actually spent more than we expected. Our rent, for some reason, has gone up. That's going to reduce my profit. I can therefore describe this variance as being adverse. Adverse variances are bad for the business, will reduce your profit. If in this case we'd actually spent less than budgeted, which would be good for profit, I would describe this as a favourable variance. So I've got an adverse variance here, so that's the first thing to look at. Is it good for the business or bad for the business? This one's bad for the business. And the second thing to always consider is what is the variance measured in? The figures we've got here are in pounds, £50,000 and £52,500. So in fact my variance here is actually already measured in financial terms, in pounds. That's literally the impact I would have on my profit. If my rent's gone up by £2,500, that's how much my profit would suffer by. So in fact this variance is already measured in pounds. So that's the first of our four, the fixed overhead expenditure variance. Well, let's now look at the fixed overhead volume variance, which actually works in a fairly similar way to the fixed overhead expenditure variance in that it's comparing budgeted to actual. Differences, we're looking at the budgeted volume of production and the actual volume of production. So instead of looking at what we're spending, we're looking at what we're making. Now in our example, we were budgeting a volume of 10,000 units, actually produced 8,000 units. Now if I take those figures to my calculation, budgeted volume of 10,000, actual volume of 8,000, well, a variance is just a difference. That's a difference of 2,000. Remember these two things we always have to consider. Firstly, is that good or bad for the business? Well, we've actually produced less than we expected. What's that going to ultimately do to my profit? Well, that's going to reduce my profit. You can imagine I'm actually getting less units out of my factory here. I'm using my factory less effectively. So this would be an adverse variance of 2,000. And what's that measured in? Well, that's actually measured in units. Now, because this is measured in units, I do need to convert it into financial terms. I need to work out what the impact will be in pounds. And to do that, we value the variance we've calculated at the standard cost per unit of, in this case, the fixed overheads. Now, if we look back to our example, now standard means expected or target based on the budgets. Now we had a budgeted fixed overhead of £50,000, which we expected to relate to 10,000 units. Now, if I work out, and you may be familiar with the concept of an OAR, an overhead absorption rate, taking the £50,000 of cost over 10,000 units, that's an OAR of £5 per unit. That's effectively what I thought the fixed cost was going to translate to on a unit basis. So if I now value my 2,000 units variance at £5 per unit, that would be 10,000 in pounds. So that's actually converting the variance into financial terms. Still going to be adverse. We got 2,000 units less than anticipated from the factory. That's going to reduce my profit ultimately. I've got fewer units to sell. And in fact, as we now move towards the final two fixed overhead variances we're going to calculate, we can actually think about why this adverse volume variance arose. I mean, the adverse volume variance means we actually produced less than we expected. There's two principal reasons why that might happen. Firstly, maybe my staff worked more slowly than expected. Maybe they didn't produce as many units as I would have hoped in the time they had. So perhaps it's to do with the efficiency of my staff. Were they slow? The second reason we may have had fewer units is maybe my staff weren't slow, but maybe they had fewer hours to produce with. Maybe I shut the factory down at 3 o'clock every afternoon, and if they've got fewer hours to produce with, they'll presumably produce fewer units. So it could be to do with their capacity to produce. And this is really where the fixed overhead efficiency and fixed overhead capacity variances come from. Well, let's have a look at the fixed overhead efficiency variance. In fact, if you've seen the labour efficiency variance, you'll be relatively familiar with the way that this one works. We start by looking at the hours that production should have taken. So we start by looking at what actual production should have taken in terms of the hours to produce. Now, the actual level of production in our example here was 8,000 units that we actually made. How long should they have taken? Well, if you remember, we've already analysed that each unit should have taken a standard of 2 hours. According to the budget, 10,000 units, we're going to take 20,000 hours. So we've got a standard per unit of 2 hours. So 8,000 units should have taken 16,000 hours. How long did they take? Well, they actually took 17,000 hours. They took a little longer than expected. My staff were obviously a bit slow. They obviously took more than 2 hours to make each unit. Now that gives me a variance of 1,000. And again, whenever you calculate a variance, whenever you calculate a difference, think of two things. Firstly, is that good or bad? Well, if my staff were slow and they took longer than expected, that's going to cost me more to pay them. So that's an adverse variance. And make sure you think about what it's measured in. That's actually in hours at this point. It would be a mistake, you can imagine, in the assessment to insert 1,000 as my result. That's the variance in hours. As ever, I want my variance in financial terms, in pounds. Now, to value my variance in hours, I need to value it at the standard cost, but the standard cost per hour. And be very careful here. Remember, the variance is in hours. If we look back at the fixed overhead volume variance, you might remember we had a variance in units, so we valued at the standard cost per unit, which was the £5. Sometimes students will take that same £5 and value this variance at £5, but it was £5 per unit, wasn't it? I need a cost per hour. Now, if I look back at the information in the original example, well, £50,000 budgeted overhead cost for 20,000 hours. If I want to work out an hourly cost, is actually going to be £2.50. So be very careful. That's a per hour fixed overhead cost that I need to use. So if I use this to value my 1,000 hours, I'm getting a variance of 2,500 when I convert it into financial terms, into pounds. Still adverse. If my staff have been slow, that's going to ultimately cost me more. So I've got 2,500 adverse as the fixed overhead efficiency variance. So my staff were slow. That's been obviously part of the reason why we ended up with lower volume than anticipated. Well, as well as the fixed overhead efficiency variance, we can also come up with fixed overhead capacity variance. Now, capacity is looking at the ability to produce based on the number of hours you've got to work. You can imagine if you work more hours in a day than normal, that gives you a higher capacity to make things. If you work fewer hours, that gives you a lower capacity to make things, regardless of how fast or efficient you are. Now, to work out the fixed overhead capacity, a bit like most variances, we're comparing budgeted, in this case hours available, versus the actual hours that were worked. Now, in the original example, we were told that the budgeted hours was 20,000. They actually only worked 17,000. They had fewer hours to produce. That's another reason why volume will be down. So budgeted hours of 20,000, actual hours of 17,000. That gives me a difference or a variance of 3,000. Again, remember the two things to consider. Is that good or bad? Well, this is bad. Fewer hours will lead to fewer units. So this is an adverse variance. If they've got fewer hours to produce in, they'll be producing fewer units. At the moment, the variance is in hours. And to convert from a variance in hours to a variance in financial terms or in pounds, we value at the standard cost, and because it's a variance in hours, it's the standard cost per hour. If you remember, the standard cost per hour is my £2.50, so be careful that you don't mistakenly use the £5. Remember, the £5 is a fixed overhead cost per unit, and this variance isn't in units. And 3,000 hours at £2.50 per hour gives me 7,500 adverse as my variance in pounds. And at this stage we can actually do a double check, because if you remember, I explained that the fixed overhead efficiency variance and the fixed overhead capacity variance effectively break down the overall fixed overhead volume variance. So if I was to add back 7,500 adverse and 2,500 adverse, well, if you combine them, they do indeed give 10,000 adverse as the overall volume variance that we came up with. So that's a good indication that we've probably got our numbers right. So we've seen the approach to calculating each of our 4 fixed overhead variances. We had the expenditure variance, the volume variance, the efficiency variance, and then the capacity variance. Now, as I said, these are variances that students often quite hard to get to grips with, so I would strongly recommend, I'll clean this up, maybe put my answers to one side and see if you can rework those 4 variances for our little example from scratch. See if you can work through the logic of each of them for yourself. Well, I hope you found that podcast useful in helping to decipher the approach to our fixed overhead variances. My name's Gareth. Keep an eye out for other podcasts in the future on other level 4 areas. You've got my email address there, garethjohn@fi.co.uk, so feel free to drop me an email if you'd like, and any comments about these podcasts, very gratefully received. But thank you for your attention.